We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodjevics. Joining me today is Dale Pinkert. He has 40 years of trading commodity futures and FX experience. Head of Trader Development at TradeGate Hub and the host of Face. How are you today, Dale?
Great, Tom. I've been a fan of your channel for a while. I like the fact that you don't come from trading. We were talking about this, and you ask questions that the general public would probably ask. And, I'm on both sides of the microphone. I don't know about you, Tom, but when I'm interviewing smart guys all over the world, it makes me smarter. I call it intelligence gathering when I'm interviewing somebody, and then the people that watch the videos are edified as well. So I'm definitely a believer in your mission.
Well, I appreciate that, Dale, and I definitely understand that feeling of really trying to learn as much as I can and help educate not only myself but also all of our listeners as well. And I think it's always important to get as many different viewpoints as we can to try and see, let's say, where our thesis is wrong or maybe something we missed, right?
Great viewpoint, because, people gravitate to somebody that has embraced the same narrative on a particular instrument that they have. And, what doesn't show up in your account is avoiding bad trades. Mm-hmm. So if you're open to hearing different points of view, it's very possible that you may liquidate a position, not even take one. And, changing your mind is the most important thing in this business. One of my favorite expressions is from W.D. Gann, that if you don't learn how to change your mind, you won't have any change left.
That's a good one. So over your 40 years of experience really trading here, do you think that that's one of the most important things is to really manage your emotions and retain the ability to change your mind?
Yes, it's all in our heads. I don't care what kind of system you have. If you're the one in control and executing and have issues with risk management and discipline, or you have to be in the market and, patience is really pays. There's nothing wrong with not knowing and saying, I don't know. When I was younger, I thought I had to make something up because I didn't want to feel like I felt uncomfortable with saying I don't know. And, on Twitter, people choke on I don't know and I was wrong. Mm-hmm. And if you're working with someone that doesn't say both of those things, run.
So something you mentioned there, risk management. How do you go about thinking about that and really managing, not getting killed in the markets, not getting killed by some of your trades?
Well, because the reason why you get in the market, and if that contingency is negated, the whole reason you're in the trade is negated. You shouldn't be in the trade. So dare I say the dirty word, stops. Okay, stops are important. I know that people have experienced being right the market, wrong the trade. We all have, where our timing wasn't good. But for those occasions when we're just dead wrong, even Jack Schwager, who's interviewed some of the best traders in the world, what they all have in common is some of them have gone up and down and swear they'll never trade without a stop. Now, some people are disciplined enough to use mental stops because they have a fear of being picked off and they'll just get out on their own. That means you have to be monitoring the position 24 hours a day. And really, Tom, the last time I used a mental stop, my first stop was a mental institution.
Because
don't use mental stops.
Is that because you want to be able to kind of sleep at night and relax a little bit and let the rely on the stop, and in some ways, that the word you brought up of discipline, that enforces your discipline, right?
Yes, if you don't know when you're getting in a market why you're doing it, mm-hmm. where you're wrong, if you're right, what you're looking for, you shouldn't even be clicking the mouse, and you should be journaling and writing down the trade, and you should plan the trades. My best trades are planned on the weekend. I know what I'm going to do coming into the week. I have areas that I'm looking for technical action off of, and so I'm ready to execute instead of analyze on the fly. I've made every mistake, or have seen every mistake that traders make, Tom. I've facilitated prop trading rooms and retail rooms, and I've coached and I've taught, and it's a one mistake business, and you have to be disciplined and use your stops. Don't put your stops one pip under a major low, or one pip over a triple top. If you notice, my handle is Forex Stop Hunter. And that evolved from when I was a runner on the floor of the Chicago Mercantile Exchange. And I would run orders out to the pit. And brokers had a very keen interest in anything that had STP. Yes, this was when it was done open outcry. Now they're bowling alleys on paper. And so they'd know where the stops are. And their buddies in the pit would know where the stops are. And you could tell when they were getting ready to elect them, say, there were a bunch of buy stops above the market that a lot of floor traders would get long going into those buy stops, where you would hear an audible roar in the pit. And I started to notice, even as a runner, that at times it ended up being a turning point for the day. And at other times, actually an important turning point for a few weeks or so. So, when I look at a market, I always say, where are the stops? Where are the people that need to be taken out? One of the examples that I've been talking about for several months, and I missed a whole wave in silver because of it, but 5 months later it happened. So this little double bottom in silver here, Tom, right here, I thought we had to shake out the week longs before we'd get a move to the upside. All right, we had this rally, but this week here, we took out those stops, and I don't think many people are long silver anymore. I think that they've been washed out, liquidated out, because, Mr. Market's a mean guy. It's going to shake out as many people as possible looking for an outcome in the market before it happens, then most likely salt on the wound without them. So this was, classic little stop hunt. And people probably felt okay that they were stopped. And at least, they were stopped. You could always get back in the market. But when a market takes out a major area like this and it's trading 50 cents above it, it wasn't such a great out. So I look for where the market has stops. I think there are a lot of stops above the market and tons of stops along the way on the upside in euro.
But before we move on there, Dale, can we go back to the silver chart and
there is,
get from your perspective, how do you see the let's say the theory of gold and silver manipulation over the years here? We sometimes we see at very illiquid times of the market, silver drop and a lot of silver contracts being sold into the market. So what is
you
your
mean
take
like
on
the
that?
COVID low?
Well, I don't know that would be a great example, but let's say the longer term manipulation of gold and silver being held down.
The paper market is, and that's why Sinclair opened up the Shanghai exchange for the liberation of gold and silver from the paper market tyranny. Okay, so it's part of the market, and one day, I know the stories that there's not enough silver to cover all the short contracts in silver. One day they'll be squeezed. It's just, so every market's manipulated, Tom. We've had the central bank intervening in the markets for 10 years. No one complained when it was a bull market. They only complain about, they're going to start complaining about the Fed now. Why did you they already are. They stayed easy too long, and now they're going to have to cause a severe recession to get things like oil down. I don't know how they bring soybean prices down. They can't print corn. I don't care if
fertilizer or natural gas.
Right. I mean, rates could go to 20%. I was trading when Volcker was around, Tom.
Mhm.
And the last markets to break, and that was at 18, 19% T-bill rates, short-term paper,
Mhm.
was corn. So, Fed policy with bringing down agricultural commodity inflation, Jay Powell better pray for rain, right?
What do you think are the biggest differences from that Volcker era to right now that we're seeing?
The size of our debt.
And not, let's say, absolute interest rates as well?
We're still not at real rates, right?
Mhm.
Okay. But I think that the structure, something that's only 2 or 3 stories high, built on a good foundation, is much more stable than a skyscraper that really isn't up to code, that's been built on debt. Okay. So the debt burden, the percentage of GDP, we couldn't survive a Volcker tightening cycle. I'd be surprised if the Fed's able to get funds rate up to 3%. So it's because we don't have the strength, the underlying strength in this economy, because it's really been built on fiscal in the last few years and monetary stimulus. So it's not the same, and it won't take as much to topple a system that's become so top heavy with debt, especially when you have debt markets, which are bigger than stock markets, right? The biggest markets, of course, are the currency markets. But when you talk about the debt, I'll use TLT as a proxy. And, this is a pretty negative picture for long-term bonds. And the question I ask myself is, who's going to buy the runoff from the Fed's balance sheet? Do you know? I ask people.
Mhm.
I don't know who's going to be there on the other side of the trade. So, this does not speak well of what's happening in the debt markets, and it's across the board. These are sovereigns. There are people saying that they're not going to label it yet, that we're in a sovereign debt crisis. And I think the nail in the coffin will be if bonds aren't performing with a strong currency, right? Dollar, everyone loves a dollar. UUP is one of the most popular ETFs on the board. What's going to happen with a weak dollar? Are you going to want to get paid the same rate that you're getting paid when the underlying currency is appreciating? Or are you going to demand higher rates in a currency that's beginning to decline in value?
Mhm.
So the dollar's a linchpin to the whole deal. It's like all one market. If you notice, I could go through a bunch of different sectors.
Mhm.
When things are going up, almost everything's going up, right, Tom?
Mhm.
And when things are going down, almost everything's going down. So, they're all linked now. There's very little differentiation in markets, and you have to have a good eye to be able to look for relative strength if you're looking to buy things, and relative weakness when you're looking to short them.
So do you think that, when obviously our focus is gold and silver pretty heavily, but also the commodities, does that act as such a headwind, or does the dollar strength that we're seeing act as a major headwind for the metals at this point?
Well, it didn't for a while, and I think that we'll take a look at the dollar, and then we'll get to the metals. So I still think you have a lot of people. This is a month. Okay, so we're having a reversal month to the upside in euro. And I still think the long dollar trade is a very crowded trade.
Mhm.
And people are still very bullish a dollar. And, we went to, 20-year lows here, and we held them here, Tom. So we had a nice reversal. Even if it's just going to be a bear market rally, I wouldn't be playing the short side of the euro here.
Mhm.
I think that we could be looking at potentially an important low in euro, important peak in the dollar. And I think that's going to be jet fuel. In fact, I did an interview with Julian Brigden. I believe have you interviewed him at MI5 or MI2? Must be a secret agent, MI something, right? So he showed a long-term chart, Tom, of the dollar and silver. And every major bottom in silver happened with a major top in the dollar. And every major top in silver happened with a major low in the dollar. So if we're going to have a bull market in silver, we need a bear market. A bear market's necessary to support it. So I think the low that we put in last week was important. And I know there are a lot of people waiting for this level. They think they're going to buy it under 20. Go ahead. Did you have something to say?
Yeah, I was just going to ask you, do you just focus on the charts, or do you try to tie some of these macro factors in as well? I know when we see this volatility in the markets, a lot of people run to the safety of the dollar, and that's a good explanation, or seems to be a good explanation for the strength that we've seen in the dollar. So how do you see that play out?
Well, I think that's the past. And I think that we went through a paradigm shift after the sanctions. And I don't know about you, but I do know about nations, and I know about me. And do you feel comfortable if you were a foreign nation on our system, on the SWIFT system, that the U.S. government, if they don't like your policy, can freeze all your assets? I think that was a death blow to the dollar. It may take time. I mean, look, it takes time to turn a battleship around. But I think that's really a paradigm shift. It's the first time in history it's happened. And, if I didn't live in the U.S. and I disagreed with the U.S., do I have to go to bed at night wondering whether or not all of my nation's wealth is going to be frozen by an administration that changes every 4 years? So I think that that's part of it. I also think that, our friends aren't, that used to be friends, really aren't helping us. You don't see the Saudis trying to add more oil to the market. So we have a lot of adversaries now. And there are a lot of people that in life, don't you always want to see the king take a fall? A lot of people do, and we've been king for a long time. So there are a lot of people that, they say, well, it's impossible for us to lose reserve currency status. Maybe it's impossible, but it is not impossible to see, a 20, 30% depreciation of the dollar and have a dollar crisis. I'm thinking back to Doug Casey now. The 70, I think this time period is the 70s on steroids.
So, obviously that argument can be made, but also just playing devil's advocate here, thinking about
I used to watch Phil Donahue. Probably you're too young for that, but that was his shtick. He was a devil's advocate, but go ahead.
So, just to think about it from the other side, is the dollar, let's say, while that thesis can take time to play out, while let's say the devaluation and the dollar being used less, that'll take time to play out. Isn't it, at this point, some people still looking at it as let's say the cleanest dirty shirt of the bunch?
It's possible that with things happening like Target dropping 30% overnight and Target doing the same, and a lot of things in the market imploded, that maybe we're not the cleanest dirty shirt anymore. That a lot, we'll talk about us being the cleanest dirty shirt, but some of our market structure, I think, is broken. I could see a 3-month move and even 3-week move in Target lose 30%, but overnight, and it's been happening over and over again. There's something wrong with the market structure. And I think that a lot of historians will talk about the fact that when we went to all machines and got rid of the specialists that were there on the floor to put bids in, that was part of their job, instead of it being all machines, and they made an 8th or a 16th, that it was worth having them there. And I think that there's problems in our market right now. So I'm not sure, how dirty the shirt is. I think it's getting dirtier. Maybe Europe. I mean, it's the most contrarian call in the world. You have a war going on in Ukraine. Could Russia succeed and push forward? We're separated from Europe by an ocean. That's a lot of the also geo-talk on the dollar. Europe is in a stranglehold with energy because of their reliance on Russian energy. They're already in recession. The ECB is being very tentative today. They said they'll raise rates in July, so they haven't even moved yet. There's not one fundamental bullish argument for euro here, and that's why I like it.
Mm-hmm.
The reporters will tell us after a rally why it happened.
The revisionist historians, right?
What's that?
The revisionist historians.
Yeah, they'll talk about it, and what could be is this. Okay, so 10-year yields peaked, and I know a lot of people are going to say, well, the Fed's still tightening. How can that happen? And they haven't even started QT. Well, I don't know. I just look at the month we're having here in the 10-year and come back to what I'm looking at the daily. And to me, it looks like a topping formation. Okay, maybe we hold it one more time and rally, but back under 272, it's going to measure at least down to about 220. So, perhaps the interest rate differential advantage that the market has priced into the dollar might have to be repriced. So, I mean, so as you can tell, I look at how all the correlations kind of fit together. So if we have a peak in yields, we could have a peak in the dollar. And what's really tied to yields is the yen. Mm-hmm. The yen acts a little better, but if we're going to see yields come down, the yen should come down too. I think there's a shot for maybe one more high in yen, and that's because of TLT short term. And this is part of my intelligence gathering too. Some of the guys I follow down here were looking for 122, mm-hmm. But I know enough about Elliott Wave to be dangerous, Tom, and about everything to be dangerous. But after this rally completes, and maybe it completes with one more low in the S&Ps, they're looking for another decline in another spike in yields and the TLT to make one more low. Mm-hmm. But that's the long end of the market. And people are talking about the great steepening. So, the longer end could make a new low, new high in yields without the 10, the 2s or 5s.
So, when we think about rates and yields, how do you see that interacting with the SPY as you just pulled up?
Okay,
okay. I've heard you talk before about the risk on trade coming back on. Is there a particular catalyst that you're looking for that to happen?
I think the market would embrace a weaker dollar. You're hearing a lot of companies talking about how it's a headwind for them. Mm-hmm. So I think they would embrace it. I think the Fed would embrace it as well. It makes it a little easier to, maybe sell debt. But as far as the correlation with it, were we talking about the bonds, right?
Well, how the bonds relate to the SPY.
Okay. All right, that's right. So there's a guy named Martin Pring that does different cycles, and bonds usually turn first. Mm-hmm. They certainly turned before the downturn in the market, right? So the market was still grinding higher while bonds were already declining in a bear mode, right? So if you just, the S&P was good until January, right? Mm-hmm. And the interest rate picture was already beginning to change a year earlier from the COVID high. And then here's January. The same January, we were at new highs in the market. Look how far ahead the bonds are. So an interest rate turn right away isn't necessarily a signal to get long. It's going to take some time for people to embrace it if that type of scenario happens. I don't think it's going to be, just a V event for the market because the bonds are putting in a decent month. So, weekly charts are important, Tom. Monthly charts are even more important. So we have a nice reversal here in bonds, but I know guys looking for one more low. We have a nice monthly reversal in the dollar, and we have a nice monthly reversal in euro, and we don't have a monthly reversal in equities. So I think what's going to stay green are what's closing green this month. Even the metals didn't close green on the monthly. They have a wick, but they're trying to bottom. But what has turned, I think, is the euro and the dollar and the bonds. And those aren't exactly great markets to reflect a bull move in the S&Ps. Could we have a rally in the S&Ps back to 4,300? Definitely. Okay. And it doesn't need to take out a new low. We start trading over 4,100 here. You're going to see shorts run for cover. Their heads will be squeezed so hard their eyeballs will be popping out over 4,100. And just arithmetically, I like to keep it simple. You just count from, if this ends up being the low, almost 200 handles to here, is going to take you to 4,300, but I'm a seller of risk up there if that happens. I think the longer term we're headed more towards 3,400, and I could actually see how some of the big bears targets at 2,500 could happen too. But this is something that's a problem. Okay, remember you were probably doing interviews, Tom, a few years ago, and everyone was talking about a megaphone that failed. People lost a ton of money trying to pick the high of the megaphone top because we accelerated above it and had a throw over. So, I forgot about this until I went and looked at my monthly chart. We have a monthly close under 4,100, which reactivates this formation, becomes active again. Okay, it's back inside of this formation. So I don't know. I know guys talking 38. 34 seems like a viable target back to the pre-COVID highs. And take it. I try not to be a Nostradamus. I have a tendency to want to do it, but you know what really matters? Do the right thing today and tomorrow takes care of itself. But I do look at long-term ideas that give me a bias in which side of the market I want to trade.
Right.
And then gold, it's very important that we hold the lows that we put in last week. And your first, I'm considering this to be we get a pullback into 1810, 1820. I'm considering this like wave one or the first push up and maybe 1820 here. The next important hurdle for gold is going to be above this 1890 level. And this formation I was embracing for a while, that we could go all the way down towards, because this is a $200 formation from 2070, 2080 to 1880, which would measure 1680. And for a while, I thought gold might do what silver already did. You see these areas? Silver cleaned that out. Okay. See that? So that's why the gold silver ratio spiked back up towards this recent high near 89. And I think this is also evidence of a bull market coming in metals and particularly silver, because this ratio peaked a long time ago and this whole counter trend rally looks like it's over and we just have a little bit of a bear flag here. This is nothing I would buy. It looks like, you just measure from this point to this point and add it on to a breakdown and we'll be back at 80. And 82, as you can see, is going to be a real important number. That's where we broke out. So back under 82, it negates this breakout and a downtrend could begin again. Supportive makes silver your preferred long over gold, but I'm buying both because I don't trade gold silver ratio. I may use it for scalping, which market I'd prefer to, are my preferred longs or shorts, shorter term, but long term, I like them both.
Yeah. So over the last couple of weeks, obviously, we really saw, let's say, the major indices and the crypto markets just get killed. And
Yeah.
even if you don't agree with that, there was a lot of volatility. So do you think that the relative strength in the metals helps kind of support this idea of a bull market coming in the metals?
Yeah, I do. And you don't hear people debating lately what's better, gold or Bitcoin. You know what's better? It depends on your timing and everything, and your time frame and everything.
Mm-hmm.
But there's something we've covered a lot of ground here, but something I want to take the pressure off of your viewers and have them think about this. You don't have to know and have a view or really feel like you have major conviction in everything. You know what? It only takes one. I know guys that never left one trading pit, be it cattle, be it S&P 500s, be the Japanese yen, and they weren't portfolio traders, but they knew their markets like the back of their hand.
Mm-hmm.
And I think too many traders, especially that are starting, follow too many different markets. And I've heard the expression that if you can't remember the last price of any instrument you're trading too many.
Seems like a reasonable piece of advice.
Yeah. You don't have to be all over the place because there's going to be times that may be why you screen a lot of markets. Mm-hmm. But, I could run up and down my screen and go, IDK. This is interesting. Here's confluence. I could construct, there's more than one thing giving me evidence. Trading's like being a good lawyer. The more evidence that you bring to your case, at least you know what your case is, technically and fundamental, the better the case is. Mm-hmm. Than just, I have a stochastic cross. Okay.
So Dale, does that make you very neutral to the types of time frames you like to trade then? Considering you try to go based on evidence, as soon as the evidence changes, is that when you change your mind?
No, the market climate. Like, I really think in this environment, it's very difficult to be a long-term trader. And if you don't learn how to take partial profits, you may end up just spinning your wheels because sometimes, you're not going to go broke taking profits. Mm-hmm. So maybe you don't have the full position on, but you've put something in the bank to get paid because as you've noticed in recent weeks, you could go home long and the market looks great by the close and it comes in sharply lower. Mm-hmm. Well, if you didn't go the door, that trade's gone. At least you took something off the table and get to break even as soon as possible. Yeah. So you start off with a risk, stop, and your next move is to trail it to maybe a smaller risk. And then after you've taken half of your position off, the other half is break even. And the worst case scenario is you break even, you've made money. Okay, you've made money on half, broke even on the second half. It's simple, mm-hmm. right? But people don't do it.
And that goes back to your discipline of enforcing those stops, right?
Yeah, and also not being greedy. If you're in a gold trade and you have $10 made, $15, you're way long or short, even though you might be looking for 50 or 60, take it. If you still believe, not all of it, part of your position. And then if it goes without you to your target, you're still there. And if it pulls back and you still have the same conviction level, you've just eliminated more risk on your second entry because you already have money in the bank. It's money management.
Mm-hmm. So Dale, you look at some of the gold and silver miners here. How do you pick the ones that you want to trade? Is there something in particular, like a good amount of volume that you look for to be able to trade those miners, or is it just the leverage that you get compared to let's say the underlying metals price?
Well, I have a lot of trader friends, and I believe in community. And there's guys I've known for 30 years that have been, had their own BDs or they were floor traders, and we're still in touch. And one of my friends is a great mining analyst, and I'm not good at going over the balance sheet and
Mhm.
knowing what the fundamentals are and are they a target for a buyout and things like that. It's more the I go by the technicals, and what my narrative is on the underlying commodity is what leads my interest to the shares.
Yep.
Then I look at relative strength. I mean, this was a great rally that we had in Yamana, and my buddy told me that he's seen interviews as CEO, and they're for sale if they got the right bid. And I don't know as much about juniors as you do, Tom, but I think if I'm right about gold, and gold's bottoming here, and I think we're headed to 2,500.
Mhm.
By next year, if the low that we put in last week holds and we clear that first 1890 and then 1940 level, we'll be at 2000, and I think by maybe the fall, if I'm right. That he knows things like this, or this one he was telling me about. I own some of this
B2.
BTG,
Mhm.
no debt, 4% yield while you wait. And then relative strength. Okay, so as long as some of these silver shares for the first bounce. Okay, and I looked at Endeavor. I'm looking at the juniors, and Endeavor did not make a new low when silver was making that low, like Fortuna did. It made a new low, right? Took out
Mhm.
prior lows by plenty. But look at the bounce in Fortuna. Really, way outperformed what Endeavor did. You could just tell by the rate of ascent. So what I'm looking for is when silver pulls back, maybe to mid 21 to 21 level over the next week or so, that the relative strength displayed by Fortuna over EKG compared to AG, which looks to be the weak sister. I wouldn't buy this. This looks like new lows. You have, I've renamed the RSI. I call it the real simple implicator because of what it implies. And you rarely see a market low when both price and momentum are confirming. So this is a confirmed low in AG.
Mhm.
So I wouldn't be surprised to see a new low and then us begin to diverge in EG. And that could happen here too. We could take Endeavor. This was a double bottom, not a new low, but it had a confirmed low. But it could, if it made a new low, it would diverge. But I don't think this is going to make a new low. I'll be looking at it at $3, 280 in there, and I'll be wrong under the low.
Mhm.
So that's my silver miner, gold miner plan for the coming weeks. Wrong under last week's lows on, I'm out of my silver, still have a little bit of that gold, and we'll see what happens with silver. I look to, I like this one
Mhm.
for next week.
So Dale, you mentioned a longer term thesis for some of these commodities. So do you look at the move towards more generation of green electricity as a very bullish sign for copper at this point?
Copper. I think that we're going to go through a 2-3 year kind of rough period for the fourth turning, guys. You know what I mean?
Mhm.
It's out there. There's war. There's famine. It's ever Martin Armstrong, all that stuff. But do I think that it's going to be long term? I think that we will move to EV. There's only one thing really that could cure inflation would be technology advancing, so we don't have to go to war to dig in the ground to get rare minerals, that they come up with synthetics. And I do think that there's a lot, on the drawing board that's going to be different, but we have to get through this difficult time period. And I do think that we're going to have another big run in commodities, and that I don't think we really start to deflate big time until maybe, I don't know, 2024, 25. So it's a few years because it's going to take us that long to rebuild any kind of supply chain.
Mhm.
And we have a shortage of everything, Tom. It's the shortage of everything. And it's going to, you don't just go from just in time inventory to out of time inventory building with adversaries being our suppliers to being self-sustaining and developing new supply chains. That takes time. So the tincture of time and timing and in fact, one of my favorite expressions is, money comes and goes. Time is gone forever. Make it count. I hope I've made it count for people listening today, Tom. And, I appreciate talking to you. I hope you feel better.
Well, I appreciate that. And considering I'm just getting over a cold here.
Yeah.
That's,
See, you know what? Tom, the show must go on.
It does. Yeah.
Yeah. You're a true professional.
The show always goes on, no matter if I'm sick or whatever's going on. I've never canceled an episode on a guest. So
all right. Can I as turnabout fair play? I want to ask you a question before I say goodbye. Okay.
Yeah, not a problem.
So you're known for you sold your house before the last housing crisis, and that was a great call. Okay. So, now what we're doing now with rates and everything, and everyone talking about shortage of supply stock. What do you think is going to happen in this? Are we going to have anything similar to 08, 09, or does the supply aspect of it change unless the landlord of America, which is BlackRock, that probably owns 100,000 residential houses that they took over from foreclosures, has to liquidate their holdings because they're in trouble from other stuff?
I think the reverse wealth effect that is happening, and especially if you consider how many, let's say, baby boomers own second homes, and they see their 401k accounts or their retirement accounts, their stock market accounts starting to get killed. I think that there becomes a lot of supply coming onto the market. Then when you couple that with the rising mortgage rates, I can't remember the exact numbers. I would have
cost twice as much almost now.
Well, twice as much over what's the time frame though? The last, let's say 4 months, something like that.
Yeah. Quickly.
Yeah. So you see this environment of rising mortgage rates. You see this environment of not lack of stimulus, but the fact that the savings rates are coming back down. Credit card expenditures are going again. Absolutely. They're going way back up. I don't see how that supports these high housing prices. Now, I think the risks that we saw in 08, 09 were a lot different than the ones that we see today, simply because it is my suspicion, let's say, that there is less people that have 5, 6, 7 mortgages like we saw at that time. So I don't think that makes as dramatic of a crash as we saw in 08, but I think that the overstimulated and overheated housing market that we've seen over the last year and a half is definitely coming to an end. And, all that being said, I don't claim to be a genius for, let's say, calling that top when I did sell my house. But, at that time in my life, I had been doing a lot of research, a lot of learning, and I didn't want, let's say, the market to determine the price of what I had worked so hard and saved so hard and built so much equity in. And I decided to, what's that?
Nice out.
Well, yeah. And I wanted to, let's say, put that money to work in areas that I thought were more undervalued than something that's overvalued, something that I personally have. And I know that this, let's say, this mindset isn't for everyone, but a house to me is a building with my crap in it. I don't have, let's say, an emotional connection to a house. I know, many friends that I've talked to, I've shared this mindset with them, and they say, "What, your house that's your home, that's your castle. And to have an emotional connection to a building, and let's say that's tied to a market that can be very overheated by low rates, I think can be dangerous. If you look at the biggest investment that most people are going to make in their lifetimes, why wouldn't you treat that as an investment, just like gold, silver, anything else? I don't see why we have to make that separation in our minds of our home versus any other asset that we don't want to sell at a bottom or buy at a top. And the idea of, I was actually thinking about this yesterday, the idea of FOMO in the housing market, I think is super dangerous. You're going to overbid on a house because you're worried about somebody else getting it. Instead, take a step back, try to remove the emotion. That's something that we talk about a hell of a lot on the show. Try to remove that emotion and see, okay, where's the housing market relative to where it was a year ago? Is there a possibility that the fundamentals of this market come back down? Well, maybe I should be patient instead of getting emotional about it.
I know we produce content, but, I'm also a believer in, our culture gives us signs of that. And about 6 months ago, there was this commercial where someone would walk into a scene out of place and they go, well, who are you? And they go, well, I know I'm not with you, but I own QQQ. I own the technology QQQ. I said, this is the top, QQQ. About 4 months ago, I saw this commercial by Redfin, and this lady walks into a real estate office and they make it look like an exchange. You have a ticker tape going and this and that. And the realtor goes, this one just came in and it's just a model house that she puts on a stand. And her prospect runs up to it and wraps her legs around it and goes, oh, I want it. Oh, I want it. It's over. Okay. When I saw that Redfin commercial, one last thing about housing that I found interesting, I think Harry Dent said this to me, is that houses don't die, people do. There are more permanents in the housing industry. I know they're teardowns, but, they last longer than most people.
Well,
probably a few around.
Dale, you make an interesting point about, let's say, cultural tops. And I mean, there's definitely a point to be made that you can say that it's revisionist history and you can ascribe meaning to it after the fact. But if we take, for example, and not to pick on the crypto markets, but if we take, for example, the amount of ads that we saw and sponsorship that we saw
crypto.com, right,
at the Super Bowl, right? We saw FTX, we saw crypto.com, we saw all of these different ads and stuff. And we can always look back in history and see that there were like pets.com, right? That would be a perfect example of seeing when they were advertising like crazy, that kind of marked a top. And
even Tom Brady was putting on a crypto trade.
Exactly. And
not being traded in the NFL, retiring and then coming out of retirement. In fact, I think he's coming out of retirement because he lost on his crypto. So anyway,
is that the reasoning?
Nah, it's just me. We got to have fun too. But it's something, they'd look at hemlines in the old days, would give them a sign. So as you can tell, Tom, I look at everything. And it's because it's the most fascinating jigsaw puzzle in the cosmos.
So, Dale, one last question I wanted to ask you. Considering all the volatility that we're seeing right now in the markets, do you think that this is a bad time to maybe learn how to trade? Or does that make it more exciting? And does that give us the opportunity to actually make more capital if we find good trades to put on?
Well, Tom, it's a good thing to wrap with, because I always ask my guests how long it took them to make a breakthrough and an epiphany to where they've really felt like they, could be consistent in the market. And the answer I get is like 4 years, kind of like a college degree, like being an apprentice and then a journeyman and then a master. So you can't just read a book on brain surgery and go and do it. So why do people think they could read a book on trading and do it? So the process is this: 3 to 6 months demo trading, keeping a journal, knowing why you're writing down why you're taking the trade, why you're not. Now, this is very difficult for people to do, to not take risk. People with money that don't need it and people that need it and want to make money. So both.
Mm-hmm.
It's hard to sit on your hands. Tom Petty says, the waiting is the hardest part. And so for 3 to 6 months, you go demo. And then the next 6 months, you go micro, mini, because there is, even though it's only, maybe you're only going to lose with a decent stop, 10, 15 bucks and maybe make 40 or 50. There's still money on the line, which changes what's happening in your head compared to being on a demo account. In my day, we paper traded. And it's hard to take it seriously, but it's how I learned. And when I was wrong, I would get a paper cut. Anyway, so demo 3 to 6 months, and try it with the minis and micros. There are those small contracts, and play small ball for another year or so, because most of the pros I talk to say it took 4. And you know what? If you not willing to work hard, this is hard work. It looks like you could just go and you cannot take adversity, do something else.
Yeah, I think that's really sound advice, Dale, because I personally believe, hard work plays a lot into anything you're going to do. There's a certain amount of talent that goes into any skill, but that's not going to get you across the finish line. I think hard work always has to be matched with the amount of talent you have to be able to succeed in anything.
You can't learn experience, Tom. It only happens with the passing of time and living through stuff. And in our business, it's screen time.
Yeah. Well, Dale, I appreciate the good chat here. We've covered a heck of a lot of topics. As you mentioned earlier, your Twitter handle is Forex Stop Hunter, and your website is face-experience.com. Anywhere else where our listeners can find you?
Yeah, tradegatehub.com. I share there. I share on Face. I enjoy facilitating communities and giving people a chance to avoid the landmines that I have and my contemporaries have stepped on.
Excellent, Dale. Well, I really appreciate your time and your perspective today.
All right. Thank you, Tom. Good hunting, buddy.
Thank you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.